Hey guys, welcome to Lumovest. In this video, we're going to talk about common stocks versus preferred stocks and how investors make money from these two securities. When people talk about stocks, on TV or on the internet, they're usually referring to common stocks. That's what all companies have, and generally what people invest in when they buy stocks. But a small portion of companies will also have preferred stocks in addition to common stocks. These preferred stocks are publicly traded on the stock market, just like common stocks. So today, we're going to learn about the similarities and differences between common stocks and preferred stocks. By the end of this video, you would have developed a really solid conceptual understanding of the two types of stocks available on the stock market. Let's start with similarities. Both common stocks and preferred stocks are stocks in companies. When we invest in them, we're really investing in the underlying companies. Both entitle you to claim on the company's assets and profits, meaning the money that the company makes from selling its products and services is given to both common stockholders and preferred stockholders. So, how are they different? The key differences between the two types of stocks is mainly in terms of the investment return and risk profile. Said differently, the key differences between the two is how the investors can profit from the investment and the level of risk investors have to bear. Common stocks generally have higher return potential than preferred stocks. That's because whereas common stockholders profit from both capital gains and dividends, preferred stockholders profit mainly from dividends. If you don't understand the distinction between capital gains and dividends, check out our other video explaining this concept. Preferred stock prices don't move much. They're usually contained in a tight band, so most of the investment returns will come from dividends as opposed to capital gains. This is huge. This has major impact on returns. Most of the profits in the stock market come from increases in stock prices. There are stocks whose prices can increase by 50 or 100%, but dividends may only pay 2 to 6%. Once you remove the ability to profit from stock price increases, the returns profile for stocks is much lower, and that's essentially what preferred stocks is doing. So investors in preferred stocks really don't get the same upside potential as the investors in common stocks. That said, while the preferred stocks don't have as much upside potential, they also have much lower risk. Remember, stock prices can go both ways. It can go up, but it can also go down. The common stockholders bear a much greater risk in this regard than the preferred stockholders, because the preferred stock prices don't move much. So the preferred stocks have lower profit potential, but also lower risk. Another reason why preferred stocks have a lower risk profile is because companies have to prioritize giving the money to the preferred stockholders that they're entitled to every period, before they can give money to the common stockholders. Whatever remains can be paid to the common stockholders. Said differently, they have preferred status over common stockholders when it comes to the claim on the company's profits and assets. That's why they're called preferred. Let's illustrate with an example. Say a company only has $100 million of cash to pay dividends, and say the preferred shareholders are entitled to $100 million in dividend payments. In this case, all of it will have to be paid to the preferred shareholders first, leaving nothing left for the common shareholders. In this situation, common shareholders won't receive any dividend payments. But if the company has $500 million of cash to pay dividends, preferred shareholders will only get their $100 million, and the remaining $400 million will all go to the common shareholders. The takeaway here is that preferred shareholders have more certainty of their investment returns because of this preferential treatment over common shareholders. This higher claim for assets and profits further limits the downside risk for preferred stocks. Another major difference between common stocks and preferred stocks is on voting. Common stocks usually entitle their holders to vote on corporate matters. Preferred stocks, on the other hand, is typically structured without the ability to vote. So whereas common stockholders can voice their opinion in elections by casting votes, preferred stockholders can't. So these are the distinctions between common stocks and preferred stocks. Now we'd love to hear from you. Do you guys lean towards investing in common stocks or preferred stocks, and why? Leave a comment below. Thanks for watching, guys. If you like our video, hit that thumbs up button and remember to subscribe to our channel. If you want to learn more about investing, visit our website at www.lumovest.com.